What if I told you that America's newest solution to the housing crisis isn't a solution at all, but a financial trap so deep it could chain you to your mortgage for the rest of your life? What if the very policy designed to help you buy a home is actually engineered to make sure you never truly own it? Most people won't see it coming. Most people never do. My name is Nick, and after years helping people understand how money actually works, not the fantasy version, the real version, it's time we confront something that could permanently reshape the meaning of homeownership in America. We're talking about 50-year mortgages, a policy that sounds harmless until you understand the psychology behind it. Before we tear apart the brutal math of this idea, let me ask you something. When you imagine retirement, what comes to mind? Freedom? Peace? Maybe the quiet dignity of finally living without the weight of monthly payments. For generations, that vision rested on one sacred milestone, a paid-off home. But what's coming next could erase that milestone entirely. Here's the uncomfortable reality most people ignore. The average first-time homebuyer in America is no longer in their late 20s. They're 40 years old. 40. That means 2 decades of work before you can even think about buying your first home. And the new solution politicians are selling? A mortgage that would have those same 40-year-old buyers making payments until they're 90. Yes, 90. Imagine entering retirement not with freedom, but with another half-century of debt chained to your name. And the pitch sounds so reasonable. Lower monthly payments, more affordable homeownership, a chance, finally, to live the American dream. It's the kind of promise that fits perfectly into a 30-second political ad. But like every illusion that sounds too good to be true, this one hides a nightmare. Let's break down the numbers, because once you see them, you can't unsee them. Take a $400,000 home. Nothing extravagant, just average for many U.S. markets. At a 6% interest rate, here's your future. With a traditional 30-year mortgage, you'll pay around $863,000 total. Nearly $500,000 in interest alone. Already painful, but survivable. Now, the 50-year version, that same house ends up costing you $1.26 million. You pay $863,000 in interest, almost double, just for the illusion of smaller monthly payments. Your savings? About $290 a month. You trade $400,000 of your lifetime wealth to shrink your payment by less than the price of a daily coffee habit. And here's where the trap tightens. Warren Buffett has spent decades explaining the brutal truth. Compound interest is either your greatest ally or your greatest enemy. With a 50-year mortgage, it becomes your executioner. Every extra year doesn't reduce your burden, it multiplies it. It compounds with a precision that would make a casino blush. Now imagine that power working against you for half a century. This brings us to a story far more disturbing and far more real than most Americans realize. Japan in the 1990s. A housing crisis, skyrocketing prices, families locked out of homeownership. Sound familiar? The government stepped in with the same Band-Aid solution we're being offered, 50-year mortgages. What happened next was catastrophic. Their real estate market didn't wobble. It collapsed by 70%. The recovery didn't take a year, or 5. It took 36 years. An entire generation watched their wealth vanish, their timeline stolen, their futures delayed beyond recognition. But here's the psychological twist that makes all of this dangerously effective. Your brain hates large numbers, but loves small ones. It's called payment bias. We focus on the monthly cost, not the true cost. It's the perfect trick, a tiny payment today for a lifetime of debt tomorrow. Below is your rewritten section in American English, expanded with 40% more creative punch, written in a stoic, psychology, high-tension style, designed to shock the viewer immediately, sustain curiosity, and keep them hooked for the first 30 seconds. Tone, stoic. Psychological, dramatic. Financial reality check. Length, equivalent and suitable for J2 TAM voiceover. Instead of looking at the total cost, most people only look at a single number, the monthly payment. And that tiny mental shortcut has made entire industries unimaginably wealthy, while quietly draining the financial future out of ordinary families. Car dealers figured this out before anyone. They never ask if you can afford a $40,000 car. They ask if you can handle $650 a month. Suddenly, the giant financial weight looks small, harmless, almost friendly. Because your brain isn't calculating the true cost. It's just reacting emotionally to one manageable number. The 50-year mortgage weaponizes this exact flaw in human psychology. You see that $290 of monthly savings, and your brain instantly whispers, "I can finally afford this." But what your brain refuses to tell you is the truth. Those savings cost you $400,000 in extra interest over your lifetime. That's not a mortgage. That's a slow-motion wealth extraction device dressed up as a helping hand. This is the financial equivalent of taking a payday loan from someone wearing a $1,000 suit. The monthly payment looks calm and comforting, but the total cost? It quietly buries your future. And here's the psychological trap no one talks about. You're trading short-term relief for long-term poverty. You're solving today's discomfort while creating a decades-long disaster for the future version of yourself. Trust me, future you is going to be furious. Because underneath this policy is a real crisis, one that is accelerating every year. Home prices have exploded far beyond what middle-class families can reasonably afford. Mortgage rates sit stubbornly between 6 and 7%. Nowhere near the near-zero rates everyone got addicted to over the last decade. And wages? They're not keeping up with inflation, let alone with housing. But here's the part no politician wants to say out loud. The real solution is simple, brutally simple. We need more homes. More supply always brings down prices. Economics 101. It works every time it's actually attempted. But building more housing requires courage. It requires changing zoning laws that have protected the wealthy for decades. It requires telling suburban homeowners that their perfect neighborhood needs more density. It requires political will, real leadership, not sound bites. And politicians hate that. Because 50-year mortgages? Oh, those are easy. They require zero changes. Zero political risk. Zero disruption. They simply let people borrow more money for a longer period of time, creating the illusion of affordability without lowering a single price. It's not a solution. It's a financial mirage. It's like treating a broken leg by giving you crutches made of cheap plastic. You feel better for a moment, but eventually the crutches snap and you fall harder than before. And if you think it can't get worse, it does. Exponentially worse. Because hidden inside this policy is a silent killer. Your ability to build equity. Equity is supposed to be the entire point of homeownership, the lever that creates generational wealth. It's the difference between what your home is worth and what you still owe. It is the only reason generations of Americans have climbed from working class to middle class. With a 30-year mortgage, you start building real equity after 7 to 10 years. After 15 years, you own a meaningful chunk of your home. After 20 years, you're on the doorstep of full ownership. That's how wealth was built. But with a 50-year mortgage, you're paying rent to the bank. You just get a shinier receipt. After 10 years on a 30-year mortgage, you've paid off around 16% of your loan. After 10 years on a 50-year mortgage, you've paid off less than 4%. 4%. Let me put that in brutal perspective. After a decade of payments, you could sell your home and still owe almost exactly what you originally borrowed. You gave the bank 10 years of your life and walked away with nothing. You're not a homeowner. You're a long-term renter, except you're responsible for the maintenance, the repairs, the taxes, and the insurance. And this is where the true disaster begins: retirement. For decades, the American retirement plan was simple. Work 30 to 40 years. Pay off your house by 65. Retire with Social Security plus whatever you manage to save. The whole system only worked because your mortgage was gone. Today, the average Social Security check is about $2,000 per month. The average payment on a 50-year mortgage for a $400,000 home is also $2,000 per month. Do the math. Social Security doesn't even cover your house, let alone your life. If you want, I can continue writing the next section in the same style, or rewrite the entire full script for maximum retention. Just tell me. Social Security can't even cover your housing payment. let alone food, medical bills, or the basic costs required just to stay alive. So what happens when you hit retirement age and still have 25 years left on your mortgage? Simple. You face 3 choices, each one worse than the last. Option 1. Keep working until you're 80 or 90, dragging yourself into old age simply to avoid losing the roof over your head. Option 2. Sell your home and downsize, but because you built almost no equity, the numbers don't work. Option 3. Become a financial burden on your children, something no parent ever wants, but millions will be forced into. And speaking of your children, we need to talk about the generational damage hidden inside a 50-year mortgage. For decades, homeownership was the engine of middle-class wealth in America. A family buys a home, pays it off over 30 years, and when they pass away, their children inherit a fully owned asset. That inheritance becomes the seed of stability, the thing that helps the next generation buy a home, start a business, or survive financial storms. But with a 50-year mortgage, you're not passing wealth to your kids. You're passing a debt obligation with your name scratched out and there's written in. If you die 20 or 30 years into a 50-year loan, your children inherit a house with 20 to 30 years of payments left. Their choices are bleak. Take over the debt, sell the home, and hope the tiny sliver of equity covers the remainder, or walk away and let the bank reclaim it. None of these paths build generational wealth. They build generational poverty. Now here's the insidious part most people will miss. When you make it easier to borrow more money, home prices don't become more affordable. They rise. This is basic economics. If every buyer suddenly has access to a 50-year mortgage and can afford an extra $200 or $300 a month, what happens to home prices? They rise by exactly $200 to $300. Every dollar of affordability gets eaten by the market instantly. It's like increasing everyone's bidding limit at an auction and expecting the winning prices not to explode. This is induced demand, one of the most predictable economic reactions in existence. You don't make homes cheaper. You simply pump more borrowed money into the system until prices rise right back to the breaking point. So what does a 50-year mortgage really do? It keeps monthly payments the same, but stretches them across 20 additional years of your life. The mortgage industry absolutely loves this. Why wouldn't they? They make their money from interest payments, and a 50-year loan nearly doubles those payments. They take no extra risk. You take all of it. From their perspective, this is the best policy ever invented. Banks understand compound interest better than anyone. They know exactly how lucrative an extra 20 years of payments is. Their loud support for this policy tells you everything you need to know about who wins and who loses. Here's another red flag. The same politicians pushing 50-year mortgages are the ones who've spent decades praising the American dream of homeownership. If they truly cared, they'd be fighting to increase housing supply, the only proven way to lower prices. But building more homes requires political courage. It means convincing longtime homeowners to allow more density. It means updating zoning laws stuck in the 1970s. It means doing the hard work. And 50-year mortgages? They require absolutely none. They don't upset suburban voters. They don't lower home values. They don't challenge banks or lobbyists. Everyone with power benefits. Only the borrowers suffer. And by the time those borrowers realize how deeply they've been trapped, the politicians who push this policy are already out of office, writing books about leadership. What makes this proposal even more dangerous is the type of people it preys on. The average American is already drowning in $9,000 of credit card debt at 20% interest. Many are barely chipping away at student loans they'll never fully repay. And now we're proposing a mortgage that lasts longer than their working life? That's not financial planning. That's financial triage disguised as innovation. And none of this accounts for the one force no financial plan can escape: life. If you want, I can continue rewriting the next section in the exact same tone, or stitch the entire script into one smooth viral style narration. Imagine signing a mortgage that feels less like buying a home and more like chaining yourself to a sinking ship. That's the true cost of a 50-year payment plan. Life doesn't obey your perfect budget spreadsheet, and it certainly doesn't wait for your mortgage timeline. What happens when reality hits you sideways in year 15 of your loan? With a traditional 30-year mortgage, you might have built enough equity to sell, reset, maybe even downsize. But with a 50-year mortgage, you're still underwater, trapped in debt so deep you can't sell the house without cutting a check to the bank just for the privilege of escaping. Now imagine getting divorced. Normally, you divide assets. But how do you split something that isn't an asset at all? Something that has become a financial anchor, dragging both of you into the abyss. Neither person can afford to keep the house, and neither can afford to sell it. Congratulations. Your mortgage has become the third person in your divorce, and the only one winning is the bank. And what happens when your parents get sick and need care? For generations, families used home equity to support elderly parents. But after 10 years on a 50-year mortgage, you've paid off barely 4%. There is no equity, no cushion, no lifeline. Their care becomes another weight stacked on top of your existing mountain of debt. Here's the twisted part. The politicians pushing this know exactly what they're doing. They understand compound interest better than anyone. They know a longer mortgage term makes banks richer and everyday people poorer. But they also know most voters don't think in decades. They think in monthly payments. It's the same psychology that makes lottery tickets irresistible. Humans focus on immediate relief and ignore long-term consequences. A 50-year mortgage isn't a financial tool. It's a psychological trap engineered with surgical precision. And the marketing? It'll be brilliant. You'll see commercials with smiling families moving into picture-perfect homes. You'll hear emotional testimonials from people who finally achieved home ownership thanks to lower monthly payments. The ads will use phrases like an affordable path to the American dream and a mortgage that works for working families. What they won't show you is that same family 20 years later still paying for a house that's falling apart, still owing nearly the same amount they originally borrowed, watching their retirement evaporate one monthly payment at a time. They won't show the 70-year-old who expected to retire debt-free, but instead faces 2 more decades of payments on a Social Security income. They won't show the adult children inheriting not wealth, but debt. The most infuriating part? We already know how to fix the housing crisis. The solution isn't mysterious, complicated, or designed by Wall Street. It's brutally simple. Build more houses. When supply rises above demand, prices fall. When builders compete for buyers instead of buyers competing for scraps, the entire system resets. Look at Houston. With relaxed zoning laws and fast-moving construction, they have some of the most affordable housing relative to income in the nation. Families can actually buy homes without selling their souls to a bank. Now compare that to San Francisco, where building a single house can take 4 years of permits and 6 figures in fees. Zoning laws from the 1920s block apartments near job centers. Homeowners weaponize environmental reviews to protect their property values. Which city has affordable housing? Houston. Which city is considering 50-year mortgages out of desperation? San Francisco. The pattern isn't subtle. It's embarrassing that politicians pretend not to see it. Here's the truth you need to hold on to. A 50-year mortgage doesn't solve the housing crisis. It disguises it. You're not getting a better deal. You're getting a longer sentence with nicer branding. The math doesn't lie, even when the politicians do. If you can't afford a 30-year mortgage, stretching it to 50 won't save you. It just turns your financial problems into someone else's inheritance. Don't let them transform the American dream into a generational nightmare.